Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
It's showtime. Zen and the Art of Real Estate Investing is back with another episode. Thanks for being here. If I could give you just a quick reminder of things that would really help us. We literally cannot get more 5-star reviews. I don't know what's happening. It's just stalled out. But if you love the show, just click that little 5-star, write something. I read them all. I would really appreciate it. This week we have Kevin Amolsch from Pine Financial Group. He's going to talk to you about his entire journey from being a new real estate investor, trying to figure things out, all the way to now to becoming a premier hard money lender in 4 states. He's been through it all. Let's go. This is episode 110 of Zen and the Art of Real Estate Investing with my guest, Kevin Amolsch. Kevin is the president of Pine Financial Group. He formed that in 2008 after leaving a small mortgage company. And now him and his companies have closed over, it's always more when I do the bios, over 2,200 transactions as a buyer, seller, or private money lender. They have access to a lot of private equity. He spent more than 20 years as an investor, 16 in lending, and he's also the author of 45-Day Investor and the host of Real Estate Educators, which I was on. All right, Kevin,
That's right.
Welcome to the show.
Jonathan, I am so excited to be on this side and have another conversation with you.
Yeah, I love it. We were just saying before, it's cool to go on each other's podcasts because then you come in with a completely different view. You know, as a host, you're doing one thing. As a guest, you're responding to the host. So yeah, I'm excited to have you in the hot seat as I was for you. So let's start here. When was the first time that you realized real estate could be a vehicle for your future?
Oh, gosh. So I learned about real estate reading books like many of us have. And I was just looking for some type of investment. I had a small amount saved up. So where can I invest it? And I ended up getting turned on to real estate. So I just started absorbing, books. And then I bought my first house. I was still in the Army at the time, but it was a place that I could move into when I got out of the Army. And then I rented out the bedrooms, let them pay my mortgage for me. 2 years later, I moved out and I kept that as a rental. So that was my very first rental property. I was 23 years old and I saw the value of real estate investing. I saw the appreciation of the property. I was making $350 or $400 a month in cash flow. My tenant was paying off my mortgage. And that's when it really sunk in. Like all the books, like what the books are telling me to do and how successful you could be is actually real.
It works.
You can actually do this. And so it was at that time that I really figured out that real estate is real and real estate is going to make me rich.
Yeah. So were you deployed when you made the first purchase?
I wasn't. I was only in active duty for 3 years. I did the Guard for 1. Okay. So I was stationed in Colorado the entire time.
Yeah.
Which made it easier.
Yeah. But were you thinking at the time when you bought the first property, like, hey, this can generate something? Did you have any idea about the scale until you actually got the first check and was like, wait, this does make money, like you said?
Yeah, I had no idea the scale that I was going to grow it to at the time. I was really just focusing on what should I do with this little bit of money that was sitting in my savings account. But here's the thing. I ended up turning it into a career. I never planned to do that either. I was just trying to look at maybe an investment. Maybe I buy one property every 2 years or something, which would change your life if you do even that. But I ended up buying 1 or 2 houses every single month.
Wow. Yeah, even in the beginning?
Pretty early on because I fell in love with it. So I started chasing foreclosures, and that's an interesting story, but that turned into a complete disaster. I am not,
as it can.
I'm not good at that. Yeah.
Well, let's go into that a little though. What were the biggest hiccups that you had with foreclosures? Were they courthouse steps buys or something different?
Yeah, no, I was not in a position to do that type of foreclosure investing. So I was definitely trying to get more creative so I could bring in some capital. It would be easier for me to bring in capital. Look, I was in college at the time. I wasn't my refrigerator consisted of a can of beans and a keg. I didn't have money to do the business. So what I decided to do is chase foreclosures on the short sale side, because I figured if I can get some short sales accepted, then I could attract some capital.
Yeah.
And I was learning all of this going to, the conferences and doing the mentorship programs, and I was trying to get help that way.
Yeah.
And so they just sold me, man. They're like, this is easy. Not many people chase no equity foreclosures. So you're going to be on your little island. You're going to eliminate your competition, all of things that you want to hear. And I finally got one. And what my coach told me at the time, which is terrible advice, by the way, but they said, you have to get the property under control. And the best way to control the property is to get the deed, which is not true. You could get a control of a property with a contract.
Right.
And you could literally do like no earnest money and still have a legitimate contract, which I've learned all of this later. But at the time I was like, well, let's get the deed. So I have control. The owner wanted $3,000 to deed me his house. There's no equity in the property.
Yeah.
He didn't deserve anything. And I didn't have $3,000. So I went and brought a buddy. I put in 1,000. He put in 2,000. We were so excited. Like, this is going to work. We got a deed to a house, and we didn't go out and get a loan and, all of these things. And then it's like, but for this to actually work, we got to create the equity.
Yeah.
Now I got to go to the bank and negotiate for them to take less than what was owed on the property. And I'm really, Jonathan, thought that this was going to be a super easy process. And the bank was a pain.
The worst.
They were not, it was not a fun process. And I've done several since then, and it's all the same.
Yeah.
They lose the paperwork. This is back when there was fax machines.
Yeah.
So you're faxing in this big.
Yeah. Oh, it came in. We couldn't see the price. Short sale is one of the biggest oxymorons in the business. Like, there's very few short sales that actually short, they're all long in terms of time. So it's your expectation going in. It sounds easy. Like, a short sale makes it sound easy, not knowing that the short's on the mortgage end. So
yeah, and it's actually very short once you get the approval. So I was successful on several of them, and then it's like, okay, now you have 2 weeks to close.
Yeah, that's a great point too. I've found that the best short sales are the ones that have failed with someone else before, because you just hop into the seat that they were already driving their car with, and you just go with it. And those you can close right away. Everyone says it's bad when you're the first person and the listing agent, if it's on the market, hasn't even cleared anything with the lender, because they technically don't start clearing anything with the lender until they get a contract or contracts in.
Right.
Then they do the BPO, and that's why you see prices go up, where people are like, that's not possible. Yes, it is, because the bank never approved the listing agents doing it to get more people in the door, get more clients. So they list it at 100 when they know it's, they know what the upset value is, and that it's a 200, market value. So that's the play on short sales. So after you got through those, what did you kind of figure out was your investment strategy as you were getting older?
Yeah, I'm going to go into just a tad more detail on this, because it's actually kind of funny. Yeah. So I made a lot of mistakes here. This was my very first creative deal. So I actually started rehabbing the house before the offer was accepted from the bank, because I owned the house, right? It's like, might as well just start rehabbing it. And it was such a disaster. I remember this one. There was this refrigerator in the basement, and it was one of those basements where you have to open the door and then you walk down it's a very straight staircase down. I can still see this so clear. This was over 20 years ago. And the refrigerator got stuck in the stairwell going up, and it was down there for years. And when we were trying to shake it to get it to go up the stairs, the door came open and all this stuff came flying out. And we instantly started throwing up. It was the most disgusting thing. So anyway. The bank
the listeners are thanking you for that story now, but
I know,
look,
it's like
it happens though. I mean, I think that a lot of us who try to DIY stuff, which I did not do a lot because I knew I was going to experience way worse than that. This is part of the journey. You take it now, and now 20 years later, you can laugh at it and know, I'm never going to try to push a refrigerator up, these tiny stairs again. But this is important.
Get a dolly or something.
Yeah. I mean, preferably for me, I just don't do it. I just don't want to get injured. I'm getting too old.
That's so funny.
Yeah. So
Steve was on the bottom, and I was on the top polling, and he was pushing. And I just remember him jumping over, trying to crawl to get out of there so he can get some fresh air.
Yeah.
It was pretty funny. So the bank said no, which totally baffled me, because all the coaching and all the books and all the home study courses said this is so easy.
Yeah.
And the bank said no. So I ended up losing the $3,000, right? Plus my time on starting the rehab. Yeah. So now I was at $1,000 and I lost $2,000 on my buddy's money. So that was such a terrible time for me.
Yeah.
what I ended up learning was, there's ways to get into this business without risk.
Yeah, yeah.
And so I started to answer your question now. I got into the lease options. I read a book on lease options, and I went to a little 2-hour free seminar where they try to sell you upsell you in the coaching and all of that.
Of course.
But then I bought his books, and I ended up putting together 2 lease options just with the books alone. And I was like, wow, this actually is working, and I'm cash flowing. I'm making money. His name was Peter Conti. He's still around. And so I ended up joining his coaching program, and that's what changed my life.
Oh, awesome. One question though for you: after you lost your friend's $2,000, why didn't you quit? Because I think a lot of people would just be like, well, now I've messed it up for someone else. Like I just got to go, pound a 9 to 5 or something.
Yeah, well, I mean, first of all, there's no quit in me. I really do believe that you only fail when you stop. And I just have that mindset, which I think is a fantastic mindset for anybody to have. There's a few other tips I could share with you about mindset, but I just have that, and I'm lucky. I feel very grateful and because I have that mindset. But I got to tell you, I got the bug. When that first house, and I saw the appreciation and I saw the profit, I was making money on that, and I wasn't even working on it, right? Somebody else was doing all of this for me. So I knew it could be successful. I just didn't know how yet. I was just trying to figure it out.
But that's good, though. You had confidence in the vehicle, and you accepted that this wasn't the best move on this one, but hey, I'm going to take this and learn from it. And I think there's, it's one of those divergent paths. These people are going to quit. They're going to regret it forever, probably, because they're going to work jobs they don't like, or hopefully they find something else fulfilling. But it's still this kind of thing that everybody wants to do. And then there's the others who are like, okay, I'll take that one on the chin and, make it into something. So you take these classes. It seems like, though, in the beginning, you were very adamant about taking as many, mail order or small classes to see what you could. Was that something that you grew up with, knowing that, like, hey, I want to learn from somebody else. I can't just figure it out myself?
Yeah, I think that's a good question I haven't thought about before. But I remember really young as a kid, my dad he was an entrepreneur. He tried really hard at it. He had his own computer programming little business. He was a one-man show. So I guess that's not really a business, but he was self-employed, and he was doing the multi-level marketing. Back then it was Amway. I don't know what it is now, but he was doing Amway, and I saw him fighting and trying and always doing these things. And he was always doing self-improvement. So I would see him read often. So I was at soccer practice, and I would get back to the car, and he would just be in the car, like, waiting for me and reading his books. And so I was always curious on what he was reading, and he started recommending books to me. And here I am in high school, and I was reading, books about self-improvement.
Yeah. I think that's important. I mean, and I think it goes to right now, we've talked about this. There's so much out there. So it's really part of our job to try to help people figure out, like, which things are viable, but we don't know everything. Nobody knows what, new social media person's going to show up and claim to be an investor coach. So you have to do the due diligence. But I want to know if you agree, because you've been through a lot of coaching. Obviously, you've talked to so many people in real estate over the last 20 years. I do think there's a lot of garbage out there, but I think most of the materials in almost every class, if you just do them, you're probably going to do okay, because they're not like making up stuff. They're just copying what, somebody, said 20 years ago in an audio tape. I just think that a lot of it's user error. What have you found over your years in your own journey, going into programs and then watching people, trying, either succeeding or failing in these coaching programs?
Well, here's one thing that I could tell you with everybody that I interviewed on my podcast. You probably have the same experience, but any of my friends that I hang out with that are pretty successful or really successful, one thing they all have in common is they are dedicated to self-improvement.
Yeah, for sure.
So can you get everything that you need to learn and go out and be successful by listening to podcasts and going to YouTube and not spend a dime? Yes, you can do that. Now, is that the best and fastest way? Probably not. I do think that if you buy a course from somebody that lays it all out, like these are the steps, and then you have someone that you can call and get some help, a mentor, a coach, right? Michael Jordan had a coach. I mean, I think it's pretty essential to hit potential to have coaching. So I think you should maybe do both. But to your point, there's a lot of not great coaching programs out there and not great home study courses. Now, I don't coach or offer a home study courses, so I'm not pitching anything. Yeah. I just think that it's good for you to reach your potential to have some help, someone in your corner. Yeah,
I agree. I mean, the resources are available. It also goes to the level of like what what have you put in to get there? Like you said, you're going to try a lot of the free stuff. Then when you're ready, you're going to pay for something, decide if it's worth it. And some people need to pay money to give themselves that accountability. If you get too much free stuff, I consume free stuff like it's not, I just love it. I don't care. I mean, I pay for stuff too, no problem. But I think that some people, in order to kind of light a fire under themselves, they're just going to like pay for something. It doesn't always work though, because they still don't want to do the work. That's where I think it's a user error principle.
Yeah. And I made the commitment early on. If I'm going to spend money on a book or a course or something, then I'm going to implement at least one thing out of that before I pick up another book, because I love to read. So I was just constantly reading and I wasn't doing anything with it. Right. And then 3 books down, I don't even remember what my tips were that I liked in that book.
Yeah.
So I would say, I'm going to read this book and I'm going to implement at least one, hopefully more, before I pick up another book. And that served me pretty well.
Yeah. So you got into lease options, and how long that's something that you did for a while?
Years. Yeah. So I think that, you get something that works and then you kind of focus in on that and become the expert. And then you could add to the tool belt. Everybody has their tool belt, and hard money is a perfect example. That's a tool for people to use. Now, it's not for everybody and it's not for every situation, right? But it does work for some investors in certain situations. So lease options is an example. It's another tool. A subject to is a tool. Understanding how to negotiate a short sale, that's a tool. Do you do them all at one time? No, you focus in on one, get good, add another, and then add another. And then when you're in the house talking to sellers, you have a better opportunity to help them with their situation. Yeah. Which tool is going to fix their problem and make me a profit? Lease options was what got me going and got me my marketing going. And I was getting into houses. I was meeting with between 5 and 10 sellers every single week. So I was getting all of this experience. And then that's when I started adding more tools. That's all.
Yeah, but that's so important. I always say you're walking into an off-market appointment with a toolbox. We're on the exact same level with that, because if you only are, one note, you go in and sellers don't want that. I always talk about that about cash. Like most off-market sellers, they don't really need cash. They need a solution to a different problem. So like you're saying, once you get in, the more you learn, you have, okay, well, now I have a few different things. There's a little buffet for them to choose from, and then they can't really get away from you. You have your wholesaler just like, I'm going to buy for cash, and they don't even have cash. And then there's you who says, well, I can do subject to, I can do seller finance if how's your equity? Or, I can help you wholesale it. And then for me, as with a license, I'm always like, well, I'm licensed also. Once they say, oh, I want market value, then I'm like, well, then we have to list it. And then they say, well, I don't want anyone coming in. And I say, okay, well, now let's go back, go back to direct buy. But that's really important for the toolbox. And then, so I suppose over the years, you just keep adding more into the toolbox to give yourself more options when you're out there.
Yeah, exactly, Jonathan. But I want to be very, very clear here. You're not going to be successful trying to get a big toolbox, and then go out and do business. I really do believe that you need to be hyper focused at the beginning.
Yeah.
Otherwise, you're not going to be successful at all. You're always chasing the shiny thing. Then you're never going to end up doing a deal. So learn, take the action. That's the piece that trips people up. But just focus in on one thing. Now, are you going to be able to help everybody? No. Maybe they need a cash buyer and you need to bring in some private equity, but you don't know how to do that yet. Well, maybe you lose that deal.
Right.
Fine. 2 or 3 appointments down later in the week, they might need the lease option that you understand really well. And then you do that one.
Yeah.
So, I guess that would be my point. But yes, to your point, you want a big toolbox as you progress through your career.
Yeah, but that's a great point, and that can go to the relationships that you build. So say you're one note, you're only doing lease options, but you go to a lot of masterminds, so you have friends who know seller finance and sub to, and then you're out there and they say, well, I'm not interested in that. And you say, okay, well, let me bring over my friend Matt. And then you call Matt, bring Matt over. Then you're helping somebody else get a deal because you don't know what to do. And I really agree with you. I don't think you should ever try to proceed as an investor when you really have no idea what you're doing. You can't do seller financing if you don't understand how it works. One, you're going to sound stupid. The seller's not going to trust you and it's going to fall apart. So why don't you bring in a partner, or just, you don't have to get any money from it. Like you said, just bring in someone who could show you how to do it and help the seller. That's your best move.
Absolutely. My very first fix and flip was just that. I went in there with a hammer, lease options, my hammer, and they were a screw, and I'm trying to pound the screw in with a hammer. And then I realized while I was in the meeting, it's like, I can't help you with my one tool, but I know that you just need some cash. That's what you really need. Let me call you back tomorrow, see what I could do to help you. And I called someone that I knew, met him at one of the networking things. And then him and I went over there, the week later, and he helped me negotiate the cash deal. He brought in the money and we split the profits. And that's how I did that one when I didn't know how to do it.
Yeah. And it's because we're talking, that was a while ago, but all these principles apply right now in this market.
Exactly.
It's people figuring out the problems, solving problems, and then together you can become that Swiss Army knife. If you're not, if you are only one note, you can't advance yourself 10 years in a year. You still have to do the work.
Oh,
yeah.
Yeah.
So how did you get into the lending side?
So I got recruited. I was borrowing private money, because I was at that point, I was fixing and flipping, and I had multiple pieces of my business at that time. And I just got recruited to lend money. I love the financing side of real estate. What I've learned is I enjoy putting deals together. I love the hunt, the chase, the kill, all of those things. And what I've learned is you structure your offer, you structure your conversation with the seller. All of that has to do with the money. How are you going to finance it?
Yeah.
So I just kind of fell in love with that, right? And so I got recruited to be a mortgage broker, just a regular mortgage broker, and I was going to go in with a niche of working with real estate investors because that's what I understood. And then that was, the SAFE Act and all of that came in, and we had to start getting licensing and regulation, and none of that was there when I started.
Yeah.
And I was like, pounding my head against the wall, but I decided, why don't I just be a hard money lender? I've already borrowed from it. So I just started raising private capital. That way I could control the underwriting. I can make common sense decisions. I can control the servicing of it. So this was back in 2006. And so I was doing mortgage broker and private lending. And then 2008 hit, and it's like, okay, I'm going to get rid of the mortgage broker thing. I'm going to focus on the private money lending. And that's when Pine was born. And yeah, here we are now.
Yeah. Well, let's talk debt funds a little, because that's obviously related to what we're saying. Explain what a debt fund is and why it's, especially right now, a very good option for investors outside of your traditional real estate investing.
Yeah, so this can be very confusing to people. So I want to be clear on what we're talking about here, because you have equity and debt. You can have an equity fund, and a debt fund is the investor's position in the fund. So you think about the investor going into the fund. Are you a debt or equity? But also, what are they investing in?
Right.
So you could be investing in debt or equity.
That's where I think
they're interchangeable.
Yeah, but people get caught up in that because they think, well, how can you invest in debt? And you're about to tell us.
Right. So when you're saying a debt fund, I assume like if we're investing in debt. So it doesn't matter where the money is coming from. Our investment is debt.
Yeah.
That's what we're going to talk about. So a debt fund is when I'm making loans to real estate investors. So this is a very secure position. We're always in a senior lien position at a low loan to value. So think 65 to 70% of the property's value. We like debt a lot. That's all we do because it's the safest place to be. We're the very first person to get paid. Now, are you giving up some returns to be in that position? Absolutely. Our investors make 8 to 10% return. And it's just steady, right? It's very steady every single month. On the equity side, if you're partnering, you're being a limited partner, you're investing in apartment syndications or any of those types of things, now you have some upside. We still see 18 to 20% returns on some of those investments, even in this environment.
Yeah.
But you have the downside also. So I've got 5 on my own personal side, not the Pine side, where I've invested in syndications. So now I'm going in as equity.
Yeah. And
of the 5, only one of them continued to make payments as it promised. The other 4 stopped, and 2 of those 4 had capital calls.
Yeah.
Now, capital call is when the sponsor or the owner of the asset says, we need more money to get through this whatever challenge we're dealing with. So we're going to go to all of the passive investors, and we're going to require them or ask them to contribute more money, increase the size of their investment so that we can handle this. You never have that kind of a problem on the debt side.
Yeah, and I think that's what a lot of people have been talking about. I heard it from Brian Burke and from Jay Scott. They've adjusted, debt funds as if you're a syndicator, a debt fund is interesting now because you're providing something with you're not going to have a capital call, and there are a lot of capital calls out there, and that goes to syndications in general and how people are vetting them and who the operators are. And of course, the times were a little bit rocky, and they still are going to be for commercial real estate for a while. But yeah, I just invested in my first syndication after all this time in real estate, and I did a lot of due diligence on it, worked with an operator that I knew and trusted. And also, I think I want to get your opinion on this because I've had other people on the show who've said, I think anytime when you're investing in something new, whether you're a brand new investor or you're just picking a new product, you kind of have to be okay if you make a mess up and lose the money. Like, I did good due diligence. I know that's going to be fine. But I'm also saying, like, that's on me. I'm not putting it on somebody else. I've read everything. I'm not missing anything. Do you agree with that?
Oh, 100%. And I've done some syndications that didn't go quite as planned, and investors get upset at that.
Yeah.
Even though you tell them this is risky, this is the plan, here's the potential challenges, what could slow us down. Now, they're all going to be fine, right? They're all going to get their money back plus profits and all of this, but it's still, they get angry at that. So I think if you're going to get angry if it doesn't go exactly as planned, then a syndication is probably not the right investment for you.
Yeah, I agree.
But what investment does do that? Even the stock market, which we're all told is the safest way to go. Or think about treasuries. What took down Silicon Valley earlier in the last March? The safest investment you could possibly make took them down.
Yeah.
Right. So everything has some risk.
Yeah. And I think I think everybody's job is to make it educated risk. That means doing the work yourself. You want to rely on experts that but look, there's some experts who are faking it. So you have to figure it out. I've done enough due diligence to be comfortable with my outlay, understanding that if it goes awry, I'm going to research how it went awry and if it was on me or if it was on, an operator. But I feel good about it. And I think you have to do that even when you're starting, like where we started, when you're saying we're just trying to buy a first house. You just want to be educated enough to feel comfortable enough to take action. And that takes more than podcasts and books. You need people, people who are there, who've done it before. If you have never done a deal, meeting someone who's done one deal is awesome. Because they can tell you the pitfalls, you could tell someone, hey, this is what happened on my first short sale. Don't do this. And someone's going to be listening and immediately stop a deal that they're about to tank. So I think that's important advice. Hey, this is Jonathan. Thanks for listening to another episode of Zen and the Art of Real Estate Investing. On this brief interlude, I wanted to tell you that we have a mailing list. I actually don't love mailing lists. There's so much. This is not an automated mailing list where you get on a drip campaign. These are written once a month, will eventually be at once a week again by me, direct, and they're not spammy. So if you want to sign up for our mailing list, you can go to bit.ly/streamlined with a D mail. Bit.ly is bit.ly/streamlined mail. See you there. You were saying before, though, that you have some mindset solutions. Of course, this podcast was created as the mindful approach to real estate investing. How have you kept your mindset on track to be able to grow on both the lending side, doing the debt fund, and then also as an investor over the years?
It can be very challenging. It's such a great question to ask. It sounds like maybe you ask a lot of your guests that question because it is such a fantastic question. And it's hard to answer, quite honestly. But I got to tell you, that little voice, that subconscious mind that's constantly talking to you can take you down.
Oh, yeah.
Right? So you have to figure out how can you communicate to that subconscious and keep it in check and keep it under control. So, here's a few tidbits or pieces of advice, if you want to say that I like to use. I really love meditation.
Same.
I fall off the cliff sometimes. I know I'm really terrible at it. It has to be guided meditations. I can't just sit there because my mind I can't control that. But if I have a guided meditation and I could take just 10 or 15 minutes in an afternoon or an evening, and that really helps me control that subconscious, that little voice.
Yeah.
But I also think reading is another great one. So my buddy, his name is Rafiq out in Minnesota, fantastic guy. I learned so much from him. He shared with me, the way to overcome this is reading and running. Or he says R&R. He says R&R. I was like, I like R&R.
That sounds great.
No, he's like, no, reading and running. So the reading one's pretty self-explanatory, but the running is important. The workouts and being active, and especially if you push yourself, because it's the same in your mind. If you're running, let's just picture this for a minute. If you're running and you start getting tired and it starts becoming hard, do you stop? Or do you push through that pain? And I call it short-term pain because then we get our second wind, right? That's what we're called. Yeah. But that's just pushing through our little temporary pain, and then until you get into the groove. And any type of physical activity is going to have this. But if you could push yourself through that, you're training your mind not to take yourself out when there's a little bit of a challenge, right? And it's so simple. It's just running.
Yeah.
So he says reading and running will really help you control that inner voice.
Yeah, but I think you can use those principles and attach them directly to what happens to real estate investors. When someone's not
Totally.
confident, they're always going to back out of a deal. You know what I mean? Like almost nothing has to happen. They go to inspection and somebody says like, "Oh, that window's not perfect." And they're like, "Oh, see, it's a piece of crap."
See ya.
You're like, "That's it?" We didn't even get to the basement yet. They're just looking for something because they haven't reached that confidence level. But I think the things that you're talking about, and we've talked about meditation too, I'm very regimented in that I never miss, but I'm not sitting perfectly. I think if you just do 1 minute, you're helping yourself. So if you do 5 minutes in the year or the week or whatever it is, it's only a plus. There's no loss to failing to continue every single day. I think it's just important that you're doing these things. And that's similar to the other things. I always say for people who are like, "Oh, I want to read more books." I'm like, do you realize that if you just read for 10 minutes a day, you'll easily do 12 books a year. You'll probably do 20. And they're like, "No, that's not true." I'm like, just try it. 10 minutes a day, you're going to finish most books in a month. And that's how we structure a book club. So it's much easier to do. But you just get so much information from books. And then, like you're saying, then you're adding these other things. And when you do all of them together, then everything starts to go up. Reading, running, meditation, you start to become a different person, which I found that just helps you as an investor and in your business with lending, doesn't it?
Oh, absolutely. I love the reading. 10 minutes a day is about all I do. And I got to tell you that quiets the mind. One, it motivates you and you get education from it. Like, I don't know, there's really no downside to it.
So I like to mix up the books in a different, like I'm crazy. I read like 20 different books at a time because I like to have some on Audible and I like to pick and choose. Do I want a real estate book today? Do I want something that's personal growth? Do I need fiction, which I usually listen to? But there's so much out there that you can then again take and put into play because you said before, you can go through a book quickly. And then if you just put it down and do nothing with it, did you really retain anything? I think I try to whatever I highlight, I try to then go and put into a Word doc so I can just always look at the highlights that I pulled from the book. And that way you never really lose touch with what you've consumed.
Yeah, as long as you go back and do something.
Yeah.
Right. That's another mindset that I really focus in on is, look, I know I'm going to make mistakes. Like we all are going to make mistakes. So I'm very different now, but I had a very ready, fire, aim approach to business when I got started. I was like, I am just going to freaking try it. I have nothing to lose. I don't have a lot of money, so I don't really have a lot to lose. I'm probably going to fail. So let me just go ahead and learn my lesson. Right. And so it's like, fail fast, fail forward. All those cliches that you hear, they're true.
But that goes back to us saying you're willing to lose what you're putting in. And I think that is meaning, like, I'm going to make it through this, but I have to step forward or else nothing's going to happen.
Yeah. What if you're only putting in your time and your ego?
Right. Exactly. What if your ego takes it?
Exactly.
You don't have to tell anyone that you lost 50 grand on your first property. You just eat it and go on. You're not a syndicator yet who has to validate your past deals. Just figure out what you did wrong. And I think our worst deals are probably some of the biggest learning lessons for all of us over the years. Had you not done that with a short sale, you would have continued to do the same thing, thinking it was working if you made a little bit of money, but it would have stunted your growth.
Yeah. I don't think about that very often, but what you're saying is hitting home right now as I'm here listening to you talk. Absolutely. Was that losing that $3,000 maybe the best thing that happened to me? Yeah, maybe so.
I think it can play into what you do now because you're giving money to other people and there's money in going back and forth. So losing a friend's money, I think, is a real light bulb. Like we said, you're going to go one way or the other. Am I going to give up or am I going to figure out a way to kind of make it up? And again, you try to get everybody in with full eyes so they understand, as we were saying for syndications, but everybody's on their own trajectory. We can only do so much to kind of help them get into the deal. It's still about what they're going to do inside of that and their confidence level.
Yeah. I love this. I just hope that this conversation is helping someone that's maybe getting started or newer. That's a lot of what we're talking about here. We haven't really gone into any advanced topics. So this is really about mindset and just getting off the couch and doing something. Because look, you could do nothing and be in the exact same place or worse 5 years from now, or you could just start reading 10 minutes a day, and what is that going to do?
Yeah. And then, I mean, you add the reading and you add the podcasts, you plus that, turn it into meetups, then you meet people, then people are doing stuff that you know. That's where the confidence comes from. I really don't think you can build your confidence just from reading a book because you don't know if it's valid yet. You're reading, oh, I mean, this sounds great. And then you go out and try it. It's maybe not the perfect fit. You have to figure out who's done it before and which little things you need to tweak, whether it's good advice, bad advice, or whether it just doesn't fit what your investor profile is. Over the years, when you're looking at properties, have you figured out that there's some type of investments that like it's just not for you? You're the way that you're made up isn't good for this type of investment.
Yeah, I think so. I mean, one of the worst deals I've done. Well, I've got a couple. I got a couple bad ones. I tried to convert a hotel. That was not for me.
That's tough.
Yeah, that was a mistake. And it was it was like an extended stay, like cash kind of hotel. And the property manager was stealing money from me, and that was a bad situation. I've done a handful of developments. I'm in a couple right now. Developing property is really hard.
Yeah, I agree.
And you got to be super patient. So I don't enjoy that. I enjoy cash flow, quite honestly. So with Pine Financial, our clients, for the most part, I mean, on the investor side, they invest with us for cash flow, and they passive income, right? But on the exit side, when we're loaning it out to our borrower clients, they're fixing and flipping, which I don't actually particularly like so much.
Yeah.
But I like it when they do it and they borrow from me, right? Because that's how I make my money. So I think fixing and flipping would be another one. But I really like cash flow. So I'm investing in those syndications because of the income and some of the upside on the back. I love what Pine has done, how it's generating monthly income, but I have a whole rental portfolio. And now I'm growing into some commercial assets. I bought my first warehouse building and Goodyear's my tenant, So I'm just trying to figure out how to generate passive monthly income.
Yeah.
That's where my passion is. I think I'm getting better at that.
Yeah, I think that's a lot of us who've been in the business for a while are really trying to figure out how to make things easier. And I mean, sure, I love the idea of owning like 100-unit apartment building, but I don't want to manage the manager on that. I'm never going to manage it myself. That's insane. But I don't even want to manage the management. And I think that's where you're starting to think, like we're saying, like, hey, okay, syndications, I'm an LP. I'm going to collect my checks, and some other commercial assets like that. Triple net leases are great. I mean, these are options. There's just so much out there in investing that you don't realize when you read your first book. And it's really cool how you can find it along the way. That's why, you have a podcast. Every time I have someone on, I like learning something new, and that I get off and I'm like, I should just do that. And then I'm trying to go through the mechanics, and then I do some more due diligence and I'm like, okay, that's really not for me, but I like that it works for them.
Yeah, it's funny. That's a shiny object, right? It's a squirrel syndrome.
Yeah.
And you're an entrepreneur, so you have that. I think it's built into entrepreneurs. So how do you control that? It's something I've been challenged with many times. Like, it's so easy to just chase, right? And that, as soon as I do that, every time I try to add something that doesn't fit, exactly in line with Pine, then I don't make as much money.
Yeah.
When I stay hyper focused on this is my lane, then I tend to do pretty well.
Yeah, I think it's important to allow yourself to take a peek at the shiny object. Like, you want to go look at it,
Sure.
Do a little due diligence on it. And then I usually just put it away and say it's not for me. But then I feel better that I've looked at it. Even if it somehow becomes super successful and I missed out, I'm still okay because I made the choice to look and not. But if I don't look and it's interesting to me, then I feel like I might have missed out. 20 minutes of looking at something isn't gonna hurt me too bad.
Yeah. I mean, if it's passive, I think that's different, right? Because it's not distracting you from your moneymaker. But if it's a shiny object that's going to take your time, I just don't know.
Yeah. Yeah. So are you still actively buying rental properties, or is what you're more interested now here is just going to be more passive for your end?
I'm really liking the syndication type stuff with sponsors that I know and trust.
Me too.
So I'm really enjoying that because I have more cash than time now.
Yeah. And
in the beginning, it was more time than money, right? So you just kind of, as you mature through your career, you're going to see that's going to be a shift. But yeah, I'm still trying to buy. In fact, I just had a broker call me today for a property that he saw me look at on Crexy. So I'm actively looking for some commercial assets because I think that's the next opportunity.
Yeah, for sure.
I think owner carries stuff on the single family because of the low interest rates that are locked in and high interest rate environment we're in now.
Yeah.
So if you're talking about a 3 to 6% spread in rates, you could pay more for a house if you could lock in that 3%.
Absolutely.
Right. So I think there's some opportunity there. And I think commercial. So
yeah.
I don't have the time to go chase owner carry deals anymore. That's how I got started, and I love it, but it takes a lot of work and time.
Yeah.
If I could just go out and have a broker bring me a deal or find something on the auction or Crexy or LoopNet or something like that, that's going to be a pretty decent cap and not a ton of effort, then I'm interested in that.
Yeah, me too. I'm very interested in commercial just in general, and I love hybrid. I'm under contract now on a kind of what is called a mixed use in my town, but it's really a single family house and a commercial building on one property. It's just cool. I like weird stuff, and I have friends who have weird properties, and I just like the options that it can give you. And I've always been interested in mixed use in general. And I've owned a few like strip mall-y type shopping center things in the past, and those were phenomenal in terms of eventual cash flow. It's easier than apartments because the tenants are good, but it's not easy to just pump in a renter. You have a tenant for 10 years, you're cruising along. We had a gym in one of them and they had 2 spaces, and then it's the same thing. January, they're killing it. Everybody wants that fit body. And then by June, they're like, listen, we're going to be a little behind, until,
Shoot.
And then, so there, I just think commercial is obviously going to be an opportunity, large scale and small scale, but small scale commercial is really interesting to me, and how it's going to work with all of the open options there. What are people going to be able to do with it? Our town's going to start becoming more lenient on reducing what was commercial and allowing residential, because no one's going to buy the buildings if not. So I think that's going to be an interesting one as well.
Yeah, well, you're starting to see that, especially in the office right now. It's so confusing to me how people are successful with that.
Yeah.
The office conversions that I've looked at, which I'm no expert, but the ones that I've looked at, they don't pencil. Like, it's more expensive to convert than to knock it down and build your apartment, or whatever it is you want to build. But we're starting to see some conversions. So I don't know. Maybe that will add to inventory. That would actually be good to switch that, right? Because we have too much office inventory, not enough housing.
They need incentives. I mean, for the numbers to work, there has to be some incentives that make it worth it, because depending on what type of building it is, it's not just easy to flip in. I tend to look at like commercial hybrid on Main Street. So they're really residential, type commercial buildings anyway, because then I'm defeating that. I'm not going into I have to adjust this. I can just change the zoning if they'll allow me. And, that works better for me. But I think it's going to be interesting. And I think that one thing is important. I don't think that commercial, if you're talking about just mixed use, is really like out of reach for new investors. A lot of times they just think, house hack, buy a condo. But your mixed use commercial can be really great because you get retail businesses, which are a little bit more reliable, barring a pandemic. And then you could live upstairs too. If you can do a house hack on a commercial if it's 51% residential. So those options are out there for new investors who are like, well, that sounds like it's too far away.
Yeah, and no money down transactions, creative transactions, are far more common in commercial than they are in residential.
Yeah.
Like we see, and there's a lot of owner carry going on right now because of the interest rate environment, and we're seeing owners carry back, but not as debt, as equity, so you can meet any bank requirements. And now you have your partner that brought all the equity to get the bank loan is the owner.
Yeah, that's a great point. I mean, think about it. Vacant commercial, there's no other way. You're not financing it because they're not going to finance it without active, rent roll there, especially if it's been vacant for a while. So that has to be seller carry. They're not going to have any other choices. And that's going to be a good deal sometimes both ways. But yeah, I think those deals are going to be pretty prevalent in 2024.
Yeah, I totally agree.
Yeah.
It's going to be an exciting year, right?
Yeah, I think so. I mean, it's going to be the first year that's kind of like, we had 2 years of the pandemic. Then we had like, okay, we're going super high with rates. Everybody's saying doom and gloom recession. And now I think we're going into I feel like rates are going to be pretty steady. I still think it's not going to be what people expect, but I think it's going to be an interesting year for sure.
Yeah. I kind of feel like it's probably more of the same, honestly. Floating 6.5% mortgage rates.
I agree. In the 6s the whole year is what I think. And I think that's going to, provide opportunities for sellers who realize, what, it's not coming down to 4 again. Now I'm just going to sell and buy a new house. I'll have to give up my 3.1 rate, but that's just part of it. Over the pandemic, though, and then through last year, did you see anything change really for you? Hard money is an interesting business because the flippers who use it, they're using it no matter what. It's just that you have to push your rates up to match, the possibilities that are out there and the prices.
Yeah, you know what's interesting is we are so heavily funded by private investors. So we have some bank lines, but it's pretty limited. I don't like that.
Yeah.
I was an investor through 2008, so I know what that can do. So we're pretty conservative. But I'm saying that because our cost of capital really didn't go up with all the rates changes, right? But a lot of our competitors are heavily reliant on capital markets.
Yeah.
So when those rates start going up, they have to increase their rates. So we're holding rates steady. All of our competitors, our peers are increasing their rates. It's been a fantastic year. In fact, this was the best year I've ever had. But you think about it, what I just explained, but also banks are not funding. I mean,
Yeah.
you see one of your peers, one of the largest. In fact, I read this. I'm sure it's true, but 2023 was the biggest year for bank failures ever. Now, not in number of banks, but deposits under management or assets under management, the biggest ever. And it's because a couple of pretty large banks went down, and
Yeah.
you have a Silicon Valley, and that scares other banks. And so they're like, well, what if there's a bank run on
Yeah.
us? Do we have enough cash reserves to handle that? Otherwise, we're going to be selling our treasuries like they had to do and taking all of these losses. So they're not lending as much. They're trying to stay more liquid. So guidelines are tightening up,
Yeah.
and it's all because of that, right? So now we have banks tightening, cash is tight. Where do they go to finance their fix and flips? Even if that's what they were normally doing, they come to private people, they
Yeah.
come to private individuals, they come to private companies like Pine Financial and other hard money lenders. So we saw an uptick in demand significantly.
Yeah. What states do you do lending in? I think it's 4, right?
Yeah, we do 4. We do Colorado, Minnesota. Those are our 2 primaries. And then we loan in Wisconsin and Washington, D.C.
And just generally,
I know,
obviously,
kind of spread.
you're not tied to this, but a baby flipper, which is a brand new flipper, never flipped anything. They want to get hard money right now. Today's January 4th when we're recording. What number are they looking at just generally? And then what points? Because I think it's hard to tell across the board. Sometimes I hear people like they're paying 20%. And I'm like, what are you doing? How are you ever going to make money paying 20% and 3 points? That's insane.
Yeah, so I'll take Colorado as an example. Yeah. Minnesota is a little bit more expensive because there's higher regulation and a harder foreclosure process. But in Colorado, we're at 2 points and 12.9% interest. And that's on 100% or 100% loan. So we'll finance 100% of purchase and acquisition and construction up to 70% of the value.
Yeah.
Now we treat everybody the same. So I don't care how much experience. I don't like playing games.
Yeah.
So this is the price, and do you want to work together or not? Now the newer investors, we love new investors. First time investors, fine, but we want somebody on the team doing a little hand holding.
Yeah.
So we want some experience in your corner. But yeah, if you're brand new, we'll take a shot on you for sure.
Yeah, and you guys are able to qualify the asset. I mean, that's what's really backing the deal for you. But I think that's good. I mean, that's what you kind of want to hear across the board because it helps people understand, with hard money, the more straightforward, the better. Like, this is what the rates are. For a first-time flipper, that's fair. Anyone who's like, oh, it's so much. It's like, I mean, talk to your friends. They're paying 15 and 3, especially, 6 months ago. So I like that idea of being, fair across the board and like, this is just what it costs. And I think a lot of people are comfortable with that. And that's why you have a lot of repeat clients, right? I mean, that's generally the bread and butter. It's like, hey, they're going to just keep flipping, keep using the same money.
Yeah, we're slightly over, just a hair over 80% of our business is repeats or referrals.
Oh, wow. Yeah. That's what I expected, though. That does make sense. And that goes to the business end of it, too. It's interesting, though. I have a lot of friends who are transitioning to doing much more lending, because they've built up the equity over the years. And then they have all these friends who are like, I can't get money in my area. And they're like, well, I mean, I'll give you money. So I'm seeing a lot of direct one-to-one lending. And then also investors, like yourself, who eventually were like, I'm just going to, I'm going to open up my own hard money shop and let it fly.
Yeah, we sell sometimes. If we need liquidity, we'll occasionally sell a note and generate the cash so we can go fund another loan. So
yeah, someone
who's not comfortable with the underwriting process or making sure that they have the right insurance policies in place or the right document set, all of that, maybe it's easier to just buy a note.
Yeah. Awesome. So before we hop off, Kevin, what's one piece of advice that you would give to newer real estate investors right now? They're entering the market into what we think is going to be at least a steady year. What's the best piece of advice based on your 20 years in the business that you could give them?
Yeah, I think we tried to do a lot of that today here, Jonathan. We give a lot of advice, but I would really say you've got to take action. This is the biggest mistake I see investors make. They read and they learn and they listen to podcasts and they go to the seminars and they do all this and they don't ever do anything. And it just kills me. It really, really does. So I would say you got to figure out whatever that fear is. I know it's fear, but what is causing that fear and what are you afraid of? And go at that. You got to figure that out, because once that's solved, and it's never going to be solved.
Right.
Look, they're picking up the phone and cold calling someone is scary. Okay, I get it. And it's going to be scary 20 years from now. But if you could get comfortable with doing that, maybe look beyond what the benefit might be or whatever strategy you use, I think that's what I would really focus in on if you want to be successful.
Yeah. Awesome. Well, man, it's been a pleasure. I'm glad we did it both ways. You can catch Kevin's podcast, which is Real Estate Educators. I was on, I don't know, a couple months ago, right? That was I had a great time with you.
It was great.
Where's the best place for people to get in touch with you?
We talk a lot about the economy, and I think I mentioned this when I interviewed you. Maybe I didn't, but we talk a lot about the economy in a podcast like this. And so I was starting to get questions all the time. Like, what is going on? Are we going to see a 2008 crash? And I think we're all past that now, right? Everyone is pretty much believing it's going to be a soft landing, which I don't necessarily agree with, by the way. It's not a 2008. What it's more similar to was the 1990s, the early 90s. I think it was 1990. The prices came down about 14% across the nation. A lot of recessions don't create a softening in real estate. Real estate seems to hold pretty well, but that one, it did hit. And it was because of the savings and loans crashes, the high inflation and the high interest rates, very similar to what we're seeing now. So I wrote a report comparing those two. And so I think that's a great way if anyone's interested in what's going on right now. You can get that at thepinereport.com. thepinereport.com. It's totally free. Otherwise, you can reach out to me at kevin@pinefinancialgroup.com. That's my email. I still manage my own email account, so you'll get a response from me if you do that.
Yeah. And of course, that means the website is pinefinancialgroup.com, and look up Real Estate Educators. All right, Kevin. Thanks for coming on the show. Appreciate it.
Jonathan, thank you so much.
That was Kevin Amolsch. I'm Jonathan Green. See you next episode. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.